Did you know that over 80% of middle-aged Americans struggle to start making money effectively? This is far from uncommon, as investing and managing finances is always significant challenges. Warren Buffett, the legendary investor, has devoted his entire life to mastering simple yet incredibly effective principles that build lasting wealth. In this video, you will discover 5 investment rules designed specifically for beginners to help improve your personal finances in 2025. Stay tuned until the very end to uncover the most important secret Buffett has never widely shared. Warren Buffett, one of the greatest investors in the world, has become an enduring symbol of sustainable success in finance. For over 6 decades, he has not only built a colossal fortune, but also earned a reputation through his intelligent, disciplined investing style focused on the true value of businesses. Because of this, Warren Buffett is regarded as a shining example for every investor, especially beginners, to learn from and emulate. What sets Buffett apart is not just his wealth, but how he preserves and grows his assets through market fluctuations. He consistently emphasizes the importance of long-term investing, patience, and the ability to assess a company's intrinsic value, key factors that have helped him weather tough times and maintain his position in the global financial arena. Learning from Buffett not only enhances your investment knowledge, but also helps build a solid financial foundation for the future. If you are seeking simple, actionable investment principles that deliver results in 2025, this article will guide you through 5 fundamental rules inspired by Warren Buffett's philosophy. These rules don't require you to be a financial expert or have extensive experience. They are perfectly suited for beginners who want to improve their personal finances sustainably and wisely. Rule 1. Invest in yourself first. Warren Buffett, the legendary investor, has always emphasized that the first and most important rule of investing isn't buying stocks or real estate, it's investing in yourself first. For those in middle age, especially in the United States, focusing on developing personal skills and knowledge not only sharpens your ability to make sound financial decisions, but also opens doors to career opportunities in an increasingly competitive world. Self-development is the foundation upon which you build a solid career and secure a sustainable income. When you invest your time and effort in learning, enhancing your expertise, or even acquiring soft skills like communication and time management, you become more adaptable to changes in the workplace and financial markets. This advantage keeps you from falling behind and boosts your control over your personal finances. Investing in yourself also brings another critical strength, the ability to make smarter decisions. As your understanding of finance, investing, and money management deepens, you avoid common pitfalls such as emotional investing, chasing fleeting trends, or falling into financial traps. People with a strong knowledge base see opportunities and risks more clearly, enabling them to craft sensible investment strategies tailored to their personal goals. Moreover, developing your skills expands your career prospects. At middle age, many begin to consider career shifts or advancing their current roles. Equipping yourself with new skills, professional certifications, or learning-related fields increases your market value. This not only boosts your income, but also builds confidence and peace of mind about your financial future. Investing in yourself is not just a cost for education, it is the highest yielding long-term investment. Unlike financial assets that can fluctuate, growing your knowledge and skills provides stable benefits, making you more resilient and adaptable in life and work. Therefore, prioritizing investing in yourself first is the crucial first step on the journey to successful personal finance. For you, those in middle age, start by dedicating time to reading books, enrolling in online courses, or seeking quality resources on finance and soft skills. These are the essential first steps to building a strong foundation for a secure financial future and sustainable growth in 2025 and beyond. Mastering this rule will not only improve your financial decision-making, but also create more opportunities to increase your income, making your life more comfortable and free. Investing in yourself is the key that unlocks lasting prosperity and success, embodying Warren Buffett's investment philosophy that anyone can learn from and apply. Rule 2. Only buy what you understand. One of the most important investment principles Warren Buffett emphasizes is only buy what you understand. For middle-aged individuals, especially Americans looking to begin or strengthen their personal investment journey, this rule carries immense significance. Buffett has always remained steadfast in investing only in sectors and companies he deeply understands, rather than chasing fleeting trends or market rumors. This approach helps him minimize risk and maintain the safety of his portfolio. Investing only in what you truly understand is not just a way to avoid financial mistakes, it also allows you to better control the money you put at risk. When you have sufficient knowledge about an industry or type of investment, you can accurately assess its true value, recognize positive signals, and identify potential risks. This helps you resist emotional impulses and crowd pressure, factors that often cause investors to lose money unnecessarily. Many newcomers to the financial market are drawn to get-rich-quick opportunities or hot, hyped stocks. However, without proper knowledge and understanding, chasing these trends often leads to rushed, unfounded investment decisions and heavy losses. Therefore, learning to invest only in what you truly grasp is an effective way to protect your capital while building a safer, more sustainable portfolio. A secure investment portfolio is especially critical for middle-aged investors because this is the stage when preserving and growing assets to prepare for retirement and long-term financial stability is paramount. Investing in familiar fields not only allows you to closely monitor market fluctuations, but also enables timely adjustments to reduce losses when the market turns volatile. Furthermore, this rule builds your confidence as an investor. Understanding the industry you're involved in means you can confidently analyze and evaluate opportunities and risks, thereby crafting an investment strategy aligned with your financial goals. This is exactly how Warren Buffett approaches the market. He chooses sectors he knows well, like insurance, food, and finance, to invest in long-term and effectively. In summary, only buy what you understand is not only a rule to minimize risk, but also a guiding principle for building a safe and sustainable portfolio. For those in middle age, applying this rule helps avoid unnecessary mistakes, protect capital, and increase long-term returns. When you master the knowledge and invest only in what you comprehend, you move closer to your personal financial goals while maintaining peace of mind and stability on your investment journey. This valuable lesson from Warren Buffett remains a beacon for all investors, especially those starting their financial path in 2025. Rule 3. Patience is the key. Warren Buffett is renowned for his long-term investment strategy, one of the most crucial rules that has allowed him to build a vast fortune over the decades. Patience is the key is the lesson Buffett wants to impart to all investors, especially middle-aged individuals seeking sustainable and secure wealth growth. In a volatile financial market, steadfastly sticking to a long-term investment plan helps maximize returns and avoid rash, unfounded decisions. Buffett's long-term approach shows that instead of chasing quick profits or being swept up by fleeting market trends, investors should focus on the intrinsic value of a business and hold on to stocks for extended periods. By doing so, you can harness the power of compounding, one of the most vital factors that cause wealth to grow exponentially over time. This method also effectively minimizes the impact of short-term fluctuations, which often cause panic and lead many to sell their shares during market downturns. For middle-aged investors, the rule of patience becomes even more essential. At this stage, you need a clear, disciplined strategy to protect and grow your assets in preparation for retirement or other long-term financial plans. Resisting the temptation to react to short-term volatility helps you avoid costly investment mistakes while maintaining emotional stability. Throughout your investment journey, one major benefit of patience is the ability to recognize and accurately assess the true value of your investments over time. Instead of fixating on today's stock price, you learn to view the overall growth and long-term profitability of the company. This perspective keeps you from getting caught up in temporary market hypes or unnecessary volatility. Moreover, maintaining a long-term strategy gives you financial peace of mind because you know you are on the right path, free from worries about short-term swings that might rapidly erode your wealth. This foundation is what enables you to build lasting wealth and enduring philosophy that Warren Buffett practices and encourages all investors to embrace. In summary, the rule, patience is the key, not only helps maximize returns over time, but also serves as an effective way to reduce risk and maintain stability in your portfolio. For middle-aged investors, mastering the art of holding firm to a long-term investment strategy without succumbing to short-term market turbulence will help your wealth grow steadily and safely. This is a priceless lesson from Warren Buffett, perfectly suited for anyone aiming to build a solid financial foundation in 2025 and beyond. Rule 4. Never lose money. One of Warren Buffett's most fundamental and renowned investment principles is never lose money. This rule may sound straightforward, but it serves as a guiding beacon that helps investors preserve capital and avoid unnecessary losses in a turbulent market. For middle-aged Americans, protecting their investment capital is absolutely critical to maintaining financial stability and building a solid foundation for the future. Buffett consistently emphasizes that capital preservation must be the top priority in every investment decision. Rather than taking reckless risks, he focuses on businesses with real intrinsic value, steady profits, and sustainable earning potential. This approach minimizes the chance of losing money while ensuring the safety of his capital over many years. The principle of never lose money extends beyond simply avoiding high-risk investments. It also involves rigorous risk management across the entire portfolio. Proper capital allocation, diversification, and never putting all your eggs in one basket help reduce potential losses if one investment suffers setbacks. This strategy is especially suited for middle-aged investors who need to protect their existing wealth while pursuing safe growth. Understanding the importance of capital preservation helps investors recognize that managing risk is just as vital as chasing returns. Profit isn't always the only priority. Maintaining your original capital is the foundation that allows you to continue investing and growing your wealth over the long term. This mindset also shields you from devastating financial shocks caused by impulsive decisions or herd mentality. Moreover, this rule fosters a resilient mindset, helping investors avoid the pressure and stress that come with market volatility. When protecting your capital is your foremost goal, you adopt a cautious and disciplined approach, unaffected by short-term market swings or unnecessary turbulence. In summary, never lose money is not just advice, it is a crucial strategy for protecting assets and maintaining financial stability. For middle-aged investors, this principle becomes even more essential, helping to avoid unnecessary risks and safeguard capital. When you fully understand and apply this rule, you build a stronger, more sustainable, and safer financial foundation aligned with your personal goals for 2025 and beyond. This is the invaluable lesson Warren Buffett offers to every investor. Rule 5. Diversify your portfolio wisely. Diversifying your investment portfolio is a well-known principle, but knowing how to do it smartly and effectively is something many struggle with. Warren Buffett has emphasized that while diversification is essential for minimizing risk, over-diversifying can dilute your investment returns. This is a crucial rule that middle-aged Americans should follow to build a balanced portfolio tailored to their personal financial goals. Buffett does not advocate spreading your capital too thin across too many sectors or investment products, as this can make it difficult for investors to manage their holdings effectively. Instead, he focuses on selecting high-quality investments with strong growth potential and allocating capital prudently to ensure both safety and maximum return. This is the key to reducing risk without sacrificing investment performance. Smart diversification helps investors avoid significant losses when one sector or asset experiences trouble. By allocating your capital wisely among different asset classes, such as stocks, bonds, real estate, and other investments, you create a protective barrier for your wealth against unexpected market fluctuations. This strategy is particularly vital for middle-aged investors who need to safeguard their existing capital while still seeking long-term growth. Moreover, a well-diversified portfolio adapts better to varying economic and market conditions. For example, when the stock market is volatile, investments in bonds or real estate can help balance overall risk, preventing your assets from being overly impacted. This strategy strengthens your portfolio's resilience, reduces emotional stress, and enhances the potential for steady returns. Building a balanced portfolio also allows you to adjust your financial plan flexibly throughout different stages of life, aligning with your personal goals and risk tolerance. For middle-aged individuals, this is a necessary step toward financial security, especially as retirement approaches. In summary, the rule of diversifying your portfolio wisely teaches viewers how to allocate capital smartly, minimize risk, and still optimize investment returns. This invaluable lesson from Warren Buffett is perfect for anyone looking to build a sustainable financial foundation aligned with their personal goals for 2025 and beyond. Applying this principle will help you maintain balance in your investments, protect your assets, and pursue long-term stable growth. Rule 6. Focus on value, not just price. Price is what you pay. Value is what you get. Let's delve into rule number 6, a cornerstone of Warren Buffett's investment philosophy and a principle that can profoundly reshape how you approach your financial decisions. Focus on value, not just price. Buffett himself encapsulated this perfectly when he stated, "Price is what you pay, value is what you get." This seemingly simple distinction is profound, and for many, especially those in middle age looking to secure their financial future, it's a critical lesson in distinguishing between short-term market noise and long-term worth. The price of an asset, be it a share of stock, a bond, or even a piece of real estate, is what it's trading for in the market at any given moment. This price can be swayed by a myriad of short-term factors: overall market sentiment, breaking news, relevant or not, herd behavior driven by fear or greed, or even automated algorithmic trading. In essence, price can be emotional and, at times, highly irrational. In contrast, the intrinsic value of an asset is an estimate of its true underlying worth. This value is derived from its fundamental characteristics. For a business, this means its earning power, the quality of its assets, the strength of its competitive advantages, its economic moat, the integrity and competence of its management, and its future growth prospects. Buffett understood that markets, particularly in the short run, can be voting machines driven by popularity, but in the long run, they are weighing machines, eventually recognizing true value. The intelligent investor's task, therefore, is not to simply chase rising prices or panic sell during downturns. Instead, it's to diligently assess this intrinsic value. This isn't a guessing game. It requires thorough fundamental analysis. This involves scrutinizing a company's financial statements, looking at revenue growth, profit margins, debt levels, and cash flow, understanding its business model, and evaluating its position within its industry. It means asking, is this a robust business that will likely be earning more money in 5, 10, or 20 years? A critical concept stemming from this rule is the margin of safety, a principle championed by Buffett's mentor, Benjamin Graham. This means purchasing an asset only when its market price is significantly below your estimate of its intrinsic value. Think of it as building a buffer. If your valuation isn't perfectly accurate, and it rarely is, or if unforeseen negative events occur, this margin provides a cushion against potential losses. For Buffett, this isn't just a good idea, it's a prerequisite for prudent investing. It's about buying $1's worth of assets for 50 cents. Applying this rule means cultivating patience and discipline. It means resisting the allure of hot stocks that everyone is talking about if their prices have become detached from their underlying value. It demands the discipline to do your homework, to research and understand what you are buying, and the courage to sometimes go against the prevailing market sentiment when your analysis indicates a clear discrepancy between price and value. Sometimes the best action is to do nothing if no compelling, undervalued opportunities present themselves. For middle-aged investors, this principle is particularly vital. At this stage in life, capital preservation often becomes as important, if not more so, than aggressive growth. By focusing on value and insisting on a margin of safety, you significantly reduce the risk of overpaying for assets and suffering substantial losses from which it might be harder to recover. It encourages rational, data-driven decisions over emotional reactions to market volatility, fostering a more sustainable and secure path towards your long-term financial goals, including a comfortable retirement. In essence, this rule steers you away from speculative gambling and towards disciplined, intelligent investing. By understanding that price is merely a fluctuating tag, while value is the enduring substance, you empower yourself to identify genuinely good businesses at fair or even bargain prices. This approach, consistently applied, is not just about avoiding mistakes. It's about laying a robust foundation for long-term wealth creation, a timeless lesson from Warren Buffett that is paramount for navigating your financial journey successfully. If you found this content valuable, don't forget to like and subscribe to the channel so you won't miss upcoming videos on finance and investing. Share this video with your friends and family so everyone can learn and apply these simple yet powerful investment principles. Thank you for watching and see you in the next videos.